Welcome to FinSights Daily by Finvesting, where we cover the daily updates from the world of finance that impacts your day-to-day life. I'm your host Narendran. Quick reminder, play this episode at 1.5x for a better experience if you are short on time. Today we are covering three critical stories shaping markets: gold's record surge, US-China trade tensions, and a shocking corporate fraud case that's left investors reeling. Coming to segment 1, gold's golden moment. Gold prices have been on a tear lately, hitting 95,000 per 10 grams in the local market, just 5% away from the psychological barrier of 1 lakh. The big question, will this rally continue or are we witnessing a bubble? Investment giants Goldman Sachs and UBS remain extremely bullish, with Goldman Sachs predicting prices could reach $3,700 per ounce by year end, approximately 1.05 lakhs per 10 gram. They are even forecasting $4,000 mark by mid 2026. What's driving this surge? Three key factors. First, central banks worldwide are accumulating gold reserves at roughly 80 tons monthly this year. Second, with US recession fears looming, Goldman puts those odds at 45%. Investors are flocking to gold as a safe haven, pouring money into gold backed ETFs. Third, geopolitical tensions and trade disputes have investors on edge. Billionaire Ray Dalio recently warned that President Trump's tariff policies could push the US economy into recession. Not everyone is optimistic though. Research firm Morningstar has delivered a bearish outlook suggesting gold could plummet by 40% over the next few years to around $1,820 per ounce. Their reasoning: increased supply from mining and recycling potentially outpacing demand, plus expectations that central bank purchases will slow down. However, many experts disagree with this pessimistic view, noting that such a dramatic fall would require an unlikely combination of global economic harmony. For listeners considering gold purchases, whether for an upcoming wedding or as an investment hedge, remember gold's historical reliability during uncertain times. Consider a staggered approach, purchasing small amounts over time rather than investing a lump sum at these record highs. To have a more clarity on gold as an investment, you can listen to my another podcast on gold. And moving to our second story, escalating trade tensions between US and China. We have been discussing for the past 15 days about US and China in the trade war. President Trump recently revealed that the US and China are in talks over tariffs, expressing optimism about potentially ending their long running dispute. During a meeting with Italian Prime Minister Giorgia Meloni, Trump told reporters, yes, we are talking to China. I would say they have reached out several times. These talks continue despite Trump raising tariffs on Chinese goods to a staggering 245%. This increase came after Beijing retaliated against Trump's earlier Liberation Day tariffs announcement. When asked about direct communication with Chinese President Xi Jinping, Trump remained cryptic but hinted at contact. Despite the ongoing tariff battle sending global markets into turmoil, Trump maintained optimism about reaching a very good deal. The White House later clarified that Trump believes the responsibility lies with China to re engage in negotiations. Press Secretary Caroline Levitt quoted Trump saying, quote, the ball is in China's court. China needs to make a deal with us, unquote. Beijing's response? They have urged Washington to stop threatening and blackmailing. Why should Indian investors care? First, global market volatility affects our stock markets directly. Second, Indian exporters face both challenges and opportunities as Chinese goods become more expensive in America. Third, reduced global growth could impact our export industries. And fourth, supply chain disruptions could affect Indian businesses reliant on Chinese components. For Indian investors, diversification remains key during these uncertain times, with gold potentially continuing to shine as a safe haven asset. In our final segment, we are examining perhaps the year's most shocking corporate scandal, the Gensol Engineering fraud case. Gensol Engineering appeared to be the perfect green dream, a renewable energy company growing from 61 crores revenue to a staggering 1100 crores in just 7 years. Starting as solar consultants, they expanded into EV supply for Blue Smart cabs with ambitious plans to manufacture their own electric vehicles. Investors couldn't get enough. Their shareholder count exploded from just 155 when they listed in 2019 to 110,000 by March this year. The stock price soared to 1,126, valuing the company at 4,300 crores. Meanwhile, the promoters Anmol and Puneet Jaggi quietly reduced their ownership from 70% to 35%. The first warning came in March when credit rating agencies CARE and ICRA downgraded Gensol to D for default. ICRA statement that Gensol had shared apparently falsified documents about loan repayments sent shockwaves through the market. The stock dropped by 50%, triggering a SEBI investigation that uncovered astonishing fraud. One glaring example: in September 2022, they took a 71 crore loan for EVs, but within days, 50 crore was funneled to a company controlled by Jaggi brothers who used it to buy a luxury apartment in the Camellias, one of the Gurgaon's most premium addresses. The brothers also splurged on a 26 lakh golf set, a 17 lakh shopping spree at Titan, and even 10 lakh worth of spa services, all allegedly using company funds. Beyond this diversion, their business claims were equally dubious. Their supposed Pune EV factory was found nearly empty with minimal operations. SEBI has now barred the Jaggi brothers from Gensol and prohibited them from securities trading. A forensic audit is underway. For investors, three critical warning signs emerged from this case. First, suspiciously explosive growth. Second, promoters quietly reducing their stakes during boom times. And third, ignoring expert warnings from rating agencies. Remember this golden rule: protect your capital in just as crucial as growing it. When you spot astronomical growth, promoters reducing stakes, and external warnings, it's the time to walk away. More than walk away, it's just run from the stock. Well, that's all for today's FinSights Daily. Thank you for joining me. This is Naren signing off. I'll see you in the next episode with fresh updates from the financial world. Have a wonderful evening and remember, stay financially savvy.